Hello friends, this is Raj Sastri from Raj Option Trading. Today we will talk about one of my favorite option strategies. It's really short straddle. What is short straddle? Short straddle is really a strategy where you sell at the money puts and calls with the same strike price and expiration date. So rationale is really to profit from volatility crush and stock staying within the trading range. Why we sell straddle? It's really income generating strategy. You sell a straddle, you have a limited profit potential within a very short time frame. A max profit potential is really the premium that you received. When you sell a straddle, when the IV or implied volatility is high, you can get a very good premium, and hopefully you get to keep that premium. And you want the stock to move within a trading range, so that way you kind of keep the premium that you received for most part. And you want the implied volatility to decrease, so that way you get a premium when IV is high, and you buy back when the IV is low. And max profit potential is really unlimited. um, this is when stock can go all the way high or all the way low. That's when that's when you incur a lot of losses. When do you sell straddles? When you sell straddles, your outlook is relatively neutral. So you don't want the stock to move too much high or low. And you're also looking for a volatility crush. So you have to concentrate on the stocks with the news events like earning reports or FDA announcements if it's a biotech stock, or a product release. For example, Elon Musk has a Tesla battery day. Those are the events that you look for. And you sell the straddle just before the announcement or a news event. And you sell when the implied volatility is relatively high. When these events are making their headway, the IV really goes higher. That's when you sell these straddles. And the duration is 45 days or less. So this is really, you want to make sure you are not exposed for longer, because you're selling a naked call and a naked put. You want the duration or a time to expiration to be 45 days or less. And you don't really need to hold all the way to 45 days, because you are exposing yourself risk. Look for a good profit margin, and then you sell your straddle. And from a strike price perspective, you choose at the money straddle, so that way it's the premium that you receive is really high. And really avoid holding till the expiration, because the moment you hold till the expiration, anything can happen in the time frame. So you want to take profit early or take loss early and go from there. Next, we'll basically look at an example here, just a theoretical example. So here we have a stock ABC. ABC is at $45. As you can see here, current stock price is 45. So you sell a call and a put at $45. In this example, for that we paid $7. 4 plus 3, $7, which is $700 for this for this straddle. We actually received the money because we are selling this straddle. Now, if the stock goes below 38 or above 52, this is when we incur the loss. But if the stock stays within this range, 38 to 52, we will break even. So our maximum profit potential is if the stock stays at 45. That's our strike price that we bought. We sold a call and put. If it stays there on the expiration day, that's when we get to keep entire premium. So now let's look at a real life example. For that, we look at one of my favorite stocks. It's a MicroStrategy MSTR. Here, MicroStrategy has a earnings on 10/27, which is October 27th, 2020, after the market close. So what we will do is we will sell a straddle on October 27th morning. This is very important. We are selling it in the morning. That's when the IV is high. The earnings is after the close. So this is when we sell. and we are selling it for $24.30. We get a relatively high premium here. Times 100, it's 200 $2,400 that we receive. And time to expiration, we'll limit it to 24 days because that's the next expiration date. We don't want to go too many days to expiration. Limit it to 45 days. Within 45 days, stock price on 10/10/27 is 173. Now let's look at the thinkorswim on demand and look at the chart of MicroStrategy. As you can see, MicroStrategy on the earnings day, which is October 27th at 10 a.m. in the morning. So stock is trading at 173, as you can see here, and the IV is, it's a little bit higher, but because it's earnings, that's when you want the volatility to be high to for this strategy to work. And as you can see here, stock seems to be in a good positive trend here. But our main strategy here is there is a earnings event coming after the market close. IV is high. That's what we look for, when we sell straddle. With that, let's look at the option chain here. MicroStrategy stock is at 173, and at the money straddle is right here at 175. Now close enough to 173. So we will sell a straddle at here, and let's go to the next slide here. So when we sell the straddle at this right here, we are going to receive $24.30 times 100. It's $2,400, and you can see here $2,430, and max loss is infinite, and max profit is the premium that we receive. And the buying power effect is really, as you can see here, 5,216. This might vary depending on your margin. If it's a portfolio margin, of course, it will be low. So with that, let's go execute and see what happened. So we just sold this, and as we sell this, you can see here we just after selling, the same day before market closes, we incurred about $330 loss. And next day morning, just after the earnings announcement, next day morning at 9:40, still, as you can see here, we are no profit, no loss. And the stock price, as you can see here, is 175. We sold our straddle at 173. And now, next day morning at noon, which is really after the earnings, next day morning noon, we have about $145 profit. So what we should really do is really, because we got a good profit within a day time frame, like I talked about, it's a very short time frame. It's we should sell right here, so that way we don't expose ourselves for any other news events, any fluctuations in the stock price. So if you sell the next day around noon time frame, as you can see here, we make $145. This is not max profit potential, but it's a good amount that we should pocket and go forward. On the contrary, if you want to keep the stock till the expiration date, as you can see here, 20th November, you are going to suffer a loss in this case. As you can see here, stock shot up to 226 from our price when we sold the straddle, which was 173. So because of that, you're going to expose yourself to a huge loss. So that's why, a thought of keeping the entire premium to yourself is great, but that comes at an expense, which is this huge loss you're looking at. In case you want to, hold it till expiration, which I don't recommend, have some backup strategy. Maybe, buy a call at a little bit lower strike price, so that way, things won't impact you negatively. But I would not recommend keeping the option till the expiration date, because anything can happen and you'll expose yourself. With that, hope this explains, and this can be used for any stock during the earnings announcement, but be very careful. Don't hold it too long. Just close it after the earnings announcement, or any major news announcement. With that, thank you very much. Happy trading.